Peak confidence does not feel reckless. It feels reasonable. History shows that at the very top of major cycles, optimism is not emotional excess. It is structured belief. It is supported by data, reinforced by recent returns, and validated by social consensus. This is why it is so powerful. If you study financial history carefully, the moments just before major breakdowns share a specific tone, not panic, not euphoria in the theatrical sense, but calm certainty. In 1929, the phrase permanent prosperity was not satire. It reflected genuine belief that industrial production, corporate earnings, and financial innovation had entered a new phase. Mass production had transformed efficiency, consumer credit, expanded demand, radio-connected markets. The system felt modern, advanced, stabilized. Pause for a moment. Nothing about that optimism was irrational in isolation. Productivity had increased, corporate profits had grown, technology had reshaped daily life. What mattered was not the improvement. It was the assumption of permanence. History shows that in 2000, the language changed, but the structure did not. It became the new economy. The internet was not simply a technology, it was a new paradigm. Traditional valuation models were described as outdated. Profitability could wait. Growth was enough. Again, optimism was logical. The internet did change commerce. It did reshape communication. It did accelerate information flow. But something subtle happened. Risk became abstract. When innovation accelerates, uncertainty feels like opportunity. Volatility feels temporary. The absence of historical comparison allows imagination to dominate structure. Investors believe they are not participating in a cycle, but in a transformation. Pause again. In 2008, the phrase shifted once more. Housing never falls nationally. This belief was not invented by retail investors. It was embedded in models, ratings, and institutional assumptions. Historical data suggested regional downturns, but not synchronized national decline. Optimism felt mathematical. But history shows that risk does not disappear when it's distributed. It concentrates silently. What peak confidence looks like across eras is agreement. Agreement that volatility has been reduced. Agreement that policy tools are stronger. Agreement that structural change has solved old weaknesses. Optimism becomes logical during expansions because expansions validate themselves. Rising asset prices strengthen balance sheets. Stronger balance sheets increase borrowing capacity. Increased borrowing fuels further asset purchases. The cycle reinforces its own narrative. The system doesn't collapse suddenly at this stage. It normalizes risk. Risk becomes invisible, not because it is absent, but because it is rewarded. Leverage feels prudent. Concentration feels efficient. Liquidity feels abundant. Every signal confirms stability. History shows that this invisibility is the turning point. The longer a system expands without interruption, the more participants internalize stability as a baseline condition. Risk management shifts from protection against loss to optimization of gain. Safety margins shrink because they appear unnecessary. This is where confidence peaks. And when confidence peaks, questions fade. Notice something important. At the top of cycles, criticism does not disappear. It becomes marginalized. Skepticism is reframed as pessimism. Concern is interpreted as misunderstanding. Structural warnings are dismissed as outdated frameworks. This pattern has appeared before. It appeared when railroads expanded in the 19th century. It appeared during electrification booms. It appeared during credit expansions in the early 20th century. It appeared during technology revolutions at the turn of the millennium. The story changes, the psychology does not. Peak confidence is not noise, it is structure. It is the moment when markets price not just growth, but perfection. When narratives align across institutions. When valuation assumes continuity without interruption. This is not emotional mania. It is disciplined optimism taken one step too far. History shows that expansions end not because optimism was foolish, but because systems reach constraints. Growth becomes dependent on leverage rather than productivity. Returns require increasing risk. Liquidity supports prices more than earnings do. But at the peak, this transition is invisible. Late cycle returns often feel easiest. Gains arrive with less volatility. Corrections are shallow and quickly reversed. Each rebound reinforces belief that the system is resilient. Confidence becomes consensus. And when confidence becomes consensus, structural fragility is hardest to detect. This is why peak confidence matters historically. It is not the presence of optimism that signals danger. It is the disappearance of doubt. What matters is not whether growth exists. It is whether growth requires perfect conditions to continue. History shows that when markets require perfection, they are closest to imperfection. The system doesn't collapse suddenly. It shifts quietly from expansion, driven by fundamentals, to expansion sustained by belief. And that shift is rarely recognized while it is happening. History shows that financial cycles do not end because investors become irrational overnight. They end because a structural mistake becomes normalized. That mistake is simple but powerful. Price detaches from underlying cash flow. and the detachment is justified. Overvaluation does not begin dramatically, it begins incrementally. Multiples expand slightly above historical averages. Analysts revise models upward to reflect structural improvements. Risk premiums compress because stability appears durable. At first, the shift feels subtle, then it becomes standard. What was once considered expensive becomes fair value. What was once fair value becomes cheap. Anchors move. This pattern has appeared before. In late cycle environments, narrative dominance overtakes fundamentals. Earnings still matter, but less than the story. Growth projections become more important than current performance. Future potential outweighs present constraint. Markets are not irrational during this phase. They are extrapolating. The structural mistake is not optimism. It is extrapolation without limit. History shows that during extended expansions, leverage expands alongside valuation. Credit becomes easier to access because collateral values rise. Rising asset prices justify further borrowing. Further borrowing sustains rising asset prices. The system appears self-correcting. In reality, it is self-reinforcing. Liquidity plays a central role here. When liquidity is abundant, volatility declines. When volatility declines, risk models signal safety. When models signal safety, leverage increases. This is the liquidity illusion. Participants interpret stability as strength rather than as a byproduct of expansion. Late cycle returns often feel effortless because downside is consistently absorbed. Small corrections are met with policy support, renewed buying, or credit expansion. Every dip becomes a temporary opportunity. This is not coincidence, it is structural momentum. History shows that in these phases, fundamentals slowly stop mattering at the margin. Earnings growth may slow, but multiples expand. Debt may increase, but financing remains available. Productivity may stagnate, but asset prices continue rising. The divergence between math and emotion widens. On paper, valuations stretch. Cash flows flatten. Debt ratios rise. But emotionally, investors feel secure because recent experience validates risk-taking. This is the most deceptive part of the cycle. Markets begin to price perfection. Perfection means uninterrupted growth, stable policy, continuous liquidity, no systemic shock. Every assumption embedded in price becomes conditional on ideal continuity. What matters is not that fundamentals disappear. It is that they are discounted in favor of narrative. History shows that once markets price perfection, fragility increases quietly. Because perfection is not a stable equilibrium, it is a narrow path. The structural mistake is believing that because expansion has lasted, it has been mastered. In every cycle, investors convince themselves that tools are better this time. Risk management is more advanced. Policy response is faster. Information flow is superior. Volatility has been tamed. And during the expansion, these claims appear correct. Returns compound. Credit remains accessible. Defaults stay low. Valuations expand without immediate consequence. This pattern has appeared before. The math slowly diverges from emotion. Valuations imply flawless execution. Leverage assumes stable refinancing. Liquidity depends on confidence, and confidence depends on price stability. The system doesn't collapse suddenly in this phase. It drifts further from equilibrium. The moment fundamentals truly stop mattering is not when prices fall. It is when prices rise despite weakening underlying conditions. That is when the structural mistake becomes complete. Because once price is supported primarily by expectation rather than productivity, adjustment becomes inevitable. Not dramatic, not immediate, but inevitable. And history shows that when inevitability meets overconfidence, the outcome is rarely ambiguous. History shows that every cycle believes it has solved the previous one. At the peak of expansion, the phrase, "this time is different," rarely appears explicitly. It is implied. It is embedded in explanations. It is reflected in models, in policy frameworks, and investor behavior. Each era develops its own reason why volatility has been reduced or risk has been neutralized. The explanation changes. The pattern does not. In the 19th century, railroads were the excuse. They were transformative, and correctly so. They reduced transportation costs, integrated markets, and accelerated industrial growth. Capital flowed aggressively into railroad expansion because the logic seemed unassailable, and for a time it was. But history shows that technological transformation does not eliminate cycles. It amplifies them. Railroads did not remove financial risk. They concentrated it in new forms: debt financing, land speculation, overcapacity. In the late 20th century, the internet served a similar role. It was not imaginary. It reshaped productivity, commerce, and communication. But during peak confidence, the belief extended beyond transformation. It became exemption. Traditional valuation metrics were described as outdated. Profitability was postponed indefinitely. Growth was assumed to justify any price. Technology was real. Immunity was not. The pattern repeats in more recent cycles as well. Artificial intelligence, automation, energy transitions. Each introduces genuine structural change. Each offers measurable productivity potential. But at the peak of confidence, innovation is interpreted not as progress within a cycle, but as escape from it. History shows that technological shifts modify cycles. They do not remove them. Monetary policy becomes another excuse. Central banks are assumed to have mastered volatility. Liquidity tools are believed to prevent systemic collapse. Rate adjustments, asset purchases, emergency facilities, each creates the impression that downturns can be softened indefinitely. During expansions, this belief appears justified. Interventions stabilize markets, crises are contained, volatility declines. But what matters is not whether policy tools exist, it is whether they can remove constraint. History shows that policy can delay adjustment. It cannot eliminate it. Globalization becomes another explanation. When trade networks expand and capital flows freely, risk appears diversified. Interdependence is interpreted as stability. If economies are linked, collapse in one region will be offset by strength in another. This logic holds until interdependence becomes dependency. When supply chains concentrate, when credit exposure synchronizes, when shocks propagate faster than response mechanisms, globalization does not eliminate cycles, it synchronizes them. Demographics follow the same structure. Favorable population trends are cited as long-term support. Consumption growth appears durable. Labor markets appear stable. Age distributions are interpreted as protective. History shows that demographics influence trajectory. They do not guarantee immunity. In every cycle, the narrative shifts to explain why volatility has been permanently reduced, why downturns will be shallower, why growth will be steadier, why systemic failure is unlikely. And in every cycle, confidence peaks just before fragility becomes visible. This is the silent fragility phase. It is characterized not by fear, but by calm, not by panic, but by agreement. Markets normalize elevated valuations. Leverage stabilizes at higher levels. Liquidity remains abundant. Nothing appears broken. The system does not collapse suddenly. It transitions from expansion sustained by productivity to expansion sustained by belief. Once that transition completes, reversal becomes mathematical. Cycles end logically, not emotionally. Adjustment occurs when cash flows no longer justify price, when refinancing becomes expensive, when leverage tightens, when growth slows just enough to expose assumptions embedded in valuation. Emotion follows structure. History shows that investors do not lose at the bottom of cycles. They lose at the top, when risk is lowest in perception and highest in reality, because at the bottom, prices reflect damage already recognized. At the top, prices reflect perfection assumed. This time is different appears because progress is real, innovation is real, policy evolution is real, but constraint remains real as well. The system does not fail because optimism existed. It fails because optimism ignored limits. And history repeats this lesson quietly, consistently, and without exception. Investors don't lose at bottoms. They lose at tops.